Assalamu alaikum friends. So in this video we shall see the performance evaluation issues, challenges and measures for the revenue centers. So these are the centers, these are the departments, these are the business units for which the output is measured. It's measurable in monetary terms and they earn revenue, right? That's why the revenue centers. But even though they have expenses, every department, every business unit has expenses, but their performance evaluation is actually not based on expenses. Their performance evaluation is not based on uh, the revenues they generate minus the cost, right? So the cost is taken care of as a separate budget, right? So this is the budget for the sales department. These are the number of employees. So this much the salary is, this much the discretionary expenses, this much the fixed expenses. And the performance evaluation, the given target is that you have to achieve such and such amount of revenues, right? So the marketing and sales are the two examples, right? So actual sales or ordered books, which is a proxy for the actual sales, are actually measured against the budgets or the quotas, right? So the performance evaluation will be in the form of what was set the budget. So as we did study the revenue variances, if you recall, in the sales price variance and the sales volume variance. So these kind of variances which are actually uh, the manager of such department is responsible for. So since the performance evaluation is to be done on the basis of the targets versus actual, so now means that the setting of the targets is a very important exercise, because if the target is set correctly, it is achievable and it is challenging at the same time, then of course the performance evaluation will be according to the realistic and required benchmarks. So if the target is not set correct, either it is overly optimistic or it is overly pessimistic, then of course the performance evaluation will not be good. So here the author mentions that they have expenses, but there is no effort actually to uh, deduct these expenses from the revenues while doing the performance evaluation. So moving forward, marketing and sales decisions have a profound impact on expenses incurred elsewhere in the organization. So now this is something which is important for the other cost centers, other the expense centers, because if the marketing and sales achieve, say, some higher targets than the budget, then of course some other expenses in the other departments, cost centers, will eventually increase. So that's why we usually do the flexible budget. We usually take the flexible budget for working out the variances of the cost centers, the expense centers, right? So flexible budget actually reflects the actual activity that the marketing or sales has actually achieved. So there has to be certain bounds and certain firewalls, right? So the bounds means that we may bound that, okay, the sales department is actually evaluated on the basis of the sales generated, but it cannot generate sales at every cost. So we may have bounds. For example, the credit sales will not be generated uh, at open credit, right? So the credit policy can be a bound, that the maximum credit that the company can grant is maybe 2 months or things like that, and the maximum credit profile that the company has to grant to a particular customer has to meet these conditions. So these are the bounds. The maximum amount of order that you can accept is not more than 2,000, for example. So these are the bounds, right? Uh, so another issue is the common revenue. So sometimes there are more than one marketing department, there are more than one sales department, there are more than one products, and every product has its own sales department, its own revenue department, and some customer is buying product A, and then because of product A, it also got introduced to product B, and now it is buying product B. So what is the benefit of department A to link it to the product B sales department, right? So there should be some incentive for the linking the introducing department, right, in order to enable it to connect this customer to the product B sales department. Otherwise, he will have no incentive and he will probably not be interested. So the alignment of the overall organization objectives with the objectives of the department is the challenging issue in case of these common revenues. So Apart from the in the performance evaluation for the revenue centers, apart from the uh, outputs, the revenues, we also take into consideration certain non-financial measures. For example, the customer satisfaction, the loyalty, the growth in the market share, and things like that. So in the next video, we shall see the expense centers and the performance evaluation issues attributable to expense centers. Thank you.